Good morning, everybody. It's Friday. Is that the day today? I got it wrong yesterday. It is Friday, right?
It is correct, yes.
It's February 14th. Happy Valentine's Day. Guys, if you're watching on YouTube or listening on the podcast, we love you. Happy Valentine's Day. Brian Split is here. Brian, you're looking sharp. You don't look like a poor dirt farmer to me at all.
What do I look like, Joe?
I don't know. Not a poor dirt farmer. We've got some tariff news out. Let's start there.
So President Trump plans to implement reciprocal tariffs to eliminate trade imbalances. The new tariffs would be tailored to each country, partly to encourage new trade negotiations. A White House official reported that revenue from the tariffs would help offset the projected $1.9 trillion budget deficit. However, there are concerns that the tariffs could trigger retaliation and lead to a resurgence of inflation. They may also lead to higher costs for American consumers and manufacturers. Still, Trump contends that implementing these tariffs would lead to more fair trade and create better trade deals in the long run.
Would you look at this? The White House had a fact sheet out about these fair and reciprocal tariffs. The very first thing mentioned was ethanol. The U.S. tariff on ethanol is a mere 2.5%, yet Brazil charges the U.S. ethanol export a tariff of 18%. As a result, in 2024, the U.S. imported over $200 million in ethanol from Brazil, while the U.S. exported only $52 million in ethanol to Brazil. So Trump coming to the defense, I believe, of the ethanol industry and the U.S. corn grower, perhaps.
Yeah, I mean, this is something that would be positive if we could have a little bit more equal trade here. Get more ethanol to other countries in the world. That's something that, from a demand perspective, if we could get a more solid demand base for ethanol, then the future would look a lot different. I don't know. I think the market's, really questioning the timing of all this. The press conference was yesterday, and I think the market kind of saw it and was concerned about it. If you look at equity trade, and then shrugged it off immediately, and the equities took off. So there was, I think it's going to be something we're dealing with in a couple months, and then we're going to focus on it a little bit harder. But as of right now, something like this would be good news.
Let me read something to you. In the United States, ethanol imported from Brazil is primarily utilized by fuel distributors and blenders, especially in states with low carbon fuel programs like California, Oregon, and Washington. These programs recognize the lower carbon intensity of sugarcane-based ethanol from Brazil, making it a valuable component for meeting environmental standards. Don't ask me to explain why imported sugar ethanol has a lower carbon score than U.S. corn ethanol, but it does. And this should help to push more U.S. corn ethanol into the SAF space and into the biofuel space in general. I mean, I think it's a positive. This is the second day in a row, Brian. We had some positive ethanol or SAF news to report out of the Trump administration. Yesterday, I had a story about how the administration approved a loan to an SAF plant in Montana. It's not a big deal, but it's like we're starting to see some steps in maybe the right direction here at least.
Yeah, just those little signs, right? Little positive little things that we string together. And if we can string enough of them together, that makes a pretty large impact. But back to your point, it's like, I just wonder how some of these carbon scores are even, derived. How does it
trust the science, bro? That's
yeah,
all we need to know.
right. Because it grows over there, and then we got to use energy to get it over here, and it's got a better carbon story.
We're not here to explain the science.
Right.
We're just telling you what's going on.
Right.
Let's go to the markets.
Alrighty, so corn futures traded near their recent highs early this morning. The nearby March 25 contract has peaked in the 490s on several occasions, but has been unable to break through the $5 mark. The market was able to shrug off neutral U.S. supply demand data from USDA on Tuesday. The December 25 contract posted its highest trade since June 2024 overnight. Private groups estimate that the funds were net long about 350,000 contracts at Thursday's close.
Let's go back to this March chart. Brian, to use a phrase that you might use, we have a flat base of resistance above the market. Is that an accurate description of what's going on in March corn?
Yeah, this would be what you would call an ascending triangle.
Mm-hmm.
And I think it's just evident that if we could pop through $5, that would be pretty meaningful. And then very quickly, you're going to run into the highs that were made at 508 and a quarter. That was the high in May of 24 on a front month basis. And if we can start working through some of these levels, then I think what I'm hopeful of is we maybe start hitting some air pockets where then the resistance levels in front of us start getting further and further apart, and there's not a lot of offers in those air pockets and we start to accelerate. That's what I'm hopeful of. But one thing I will tell you is that every time we get one of these dips to hold the uptrend and then go up and make a new high, that technically raises the level that we have to be mindful of, where this, if it starts to be violated to the downside, then that's going to cause some profit taking from the fund length. So every time you get one of these negative trades on a Sunday night, or you get a pullback from a report like we had this week, make a pivot low and then start resuming that uptrend, now that's notching up the important technical support.
Let's take a look at the Deese corn chart. This is a beautiful and orderly uptrend.
Love
and
it.
We posted some fresh multi-month highs, like highest trade since June overnight.
Yeah, just that huge base of lows. I mean, you can go all the way back to early June, and it was 461 and a quarter on early July 2nd, and then I think it was like July 25th we had another 461 and a quarter, and then you have that high going right into the end of the quarter at 59 and 3/4. And so basically it was like 460 down to 430 was ultimately that trading range. And so typically when you have that big range like that, you'll add that range on top of the upper end of the range. So that would suggest that 490-ish is going to be your measured objective of that strong base of lows. And I would encourage people to look at the Deese 26 chart too, because that has got a very nice, well-defined uptrend. So these contracts for further out crop years are very technically sound right now.
The uptrend has been pretty solid here. It looks to me like the market is aware that the corn situation is tight, and that we actually need to buy some corn acres. Like we need to ensure that we plant 95 million acres of corn. That's what this looks like to me.
It does, and I think we do. And when you kind of look at what's going on globally from a world stocks to use, when you look at Brazilian stocks and Brazilian stocks to use of corn, I think Brazilian stocks to use right now are projected to be the stocks to use are projected to be the lowest ever. It's like 2-point-something%. And we've seen years, their stocks to use are different when you compare like how they operate versus the US.
Yeah.
10% there is not the same as 10% here stocks to use. But I think the lowest I saw Brazil was, previously down around 4-point-something%. So the fact that it's in the twos, I think is rather significant.
Well, there isn't really any bearish supply and demand data out there with regard to corn, unless you were to look at like just Chinese ending stocks or something like that. I mean, some maybe call that an outlier. But if you look at global ending stocks, you look at US ending stocks, you look at Brazil ending stocks, everything's pretty tight. I've got some other charts for you here. You can call my support lines fair or foul, but it looks like maybe we held some sort of area yesterday in March beans.
I think what I was watching, and it's not on here, 100-day moving average. We talked about that quite a bit. And so if you go back to that peak in September, that was against the 100-day moving average. And then if you look at that high in November, which was from the November WASDE report, that was against the 100-day moving average. And then if you fast forward to the January report, that report got us above the 100-day. We kind of peaked, and then that when you have that line drawn there, that pullback to that line was also where the 100-day moving average was at that point. So we went up and got to the 200-day. We couldn't get through it the first attempt. We've come back down, and yesterday's low was right at the 100-day. So to me, when we got through the 100-day to the upside, that showed a change in behavior from the funds. They wanted to buy the 100-day instead of sell against it. And then this was our test of that thesis where the market had pulled back. And to me, if the funds continue to hold the 100-day, that shows me that they have some conviction in their length in soybeans. And so if we continue to see them buy against the 100-day like they did yesterday, I think we're eventually going to push into some new highs.
Let's do wheat real quick while we're on charts. This has been a nice orderly uptrend that began kind of, I would say, in early January.
Yeah, so one of the things that I had identified on the May contract was a head and shoulder bottom, and that suggests May works itself up to the 620-ish area is the measured objective of that. So with the carry in the wheat market, that's going to be a little higher than where you're going to see the March contract trade to hit its personal objectives. But I think, again, the fund positioning right now in wheat, they did cover some shorts on the previous commitment of trade report, but they were short, what was it, like 110,000 contracts. Now they're about 90. I still think there's more short covering ahead. And you and I had kind of talked about this when we were in Nashville, and I had said something about this actually in our conference a year ago, how I think if we eventually get the war worked out with Russia, that's going to take that low offer right from Russia, because they need to sell wheat to finance things, to continue their combat operations. And so it's an offer in wheat that is lower than it really should be, to make sure that they keep that market share. And I think if that conflict gets resolved, that offer from them gets lifted, right? And I think global wheat values go up as a result of that. So I'm hopeful that we can, find peace, because I've been in war and it's horrible, and I don't wish that on anybody. But I also think it would be positive for grain producers globally.
I taped a U.S. Farm Report with Tyne yesterday. It'll be on this weekend. And not to give you a spoiler alert, Tyne asked me, she said, how much war premium is in the markets? And my answer was 0. I said, wheat's trended lower for 2 years or more than that while this war has been going on. Why would I believe that an end to the war is now additionally bearish? Does that make sense?
Yeah, there was a transition point where it went from being concerned about losing production, and that was 2022 into spring. We priced all of that in, and then the reality of it set in, and the war turned into to me a bearish influence, because again, Russia had to offer wheat below its competitors to make sure they got the business.
All right, let's go to South America.
So CONAB raised its outlook for Brazil's total corn production on Thursday. The Brazilian crop agency pegged the crop at 122 million metric tons, up 2.1% from its January forecast. The increase was mainly due to better prospects for the country's second corn crop, which is estimated at 96.1 million metric tons. Although conditions for planting have been ideal, farmers have planted only 5.3% of the crop so far, a sharp decline from 19.3% at the same time last year. The agency slightly reduced its estimate for the country's soybean crop to 166 million metric tons. The cut was attributed to dry conditions in the southern portion of the country that have caused crop losses.
Brian, people get all worked up about the differences between USDA and CONAB, and like there's this disparity, but the reality of the situation is there's always a difference.
Yeah, I mean, think about last year, right? Think about CONAB versus USDA on Brazilian soybean production. They just never synced up. I think when you look at these agencies and their estimates of crop sizes, I try not to compare them to each other. I just try to compare them to their own estimate and what their previous estimate was.
Yeah,
so
it's a better way to do it.
Is CONAB going up or down relative to its previous estimate, not relative to what the USDA has to say?
Bottom line, the soybean crop's going to be big. The second corn crop remains to be seen, but prospects look pretty good as of right now.
John Deere's quarterly revenue dropped sharply amid ongoing struggles in the farm economy. Deere announced on Thursday that first quarter revenue fell 35% to $6.8 billion, missing analyst projections of $7.7 billion. The company's stock, which has risen about 11% this year, dropped 2.2% following the announcement. Deere has expressed concern that President Trump's proposed tariffs may further reduce profitability. Prices for industrial metals needed to make equipment are on the rise due to Trump's 25% tariff on steel and aluminum and limited production here in the U.S. Deere expects sales of large tractors and combines to decline by 15 to 20% this year.
Weak farm economy be damned. The stock market, or the Deere stock rather, is acting phenomenally well and is actually outperforming the broader stock market. Deere's up 10% year to date. The S&P is only up 4%. Over the last year, Deere's up almost 28%. The S&P is up only 22%. This is a good looking chart, Brian.
Yeah. So flat base of highs, you'd look at like 22, then again in later 22, and then in 23, you've got those three highs that were made. You've got an uptrend from 22 to 2024 lows. This suggests that the market broke out recently, and as long as we can hold basically $450 a share as support at this point. And if you look at where the market, sold off on the bad news, right, and then came back and closed off those lows, it was at that 450 area against those old highs. So I agree. I think this chart looks really good. In the context of the short-term uptrend off of 2024's lows, you could still see some pullbacks here, but I think that is a nice, well-defined trend, and this chart looks positive.
We know for a fact fundamentally that farmers in the US especially have pulled back on equipment spending. That's like one of the first things that a lot of guys cut. But Deere has made a lot of moves. They moved some jobs overseas. They've had layoffs, all sorts of stuff. They're doing what they have to do to stay profitable, whether you like it or not.
U.S. corn and wheat export sales were strong last week. Net corn sales were near the upper end of pre-report expectations at 65 million bushels. The print was up 12% compared to the previous week and 20% from the prior 4-week average. Japan was the largest corn buyer for the week. Net soybean sales were poor, falling below expectations at 7 million bushels. The print was down 52% from the previous week and 74% from the prior 4-week average. China was the largest soybean buyer for the week. Net wheat sales were near the upper end of expectations at 21 million bushels. The print was up 30% from the previous week and 45% from the prior 4-week average. Mexico was the largest wheat buyer for the week.
Look at these corn sales, absolutely phenomenal. 1.65 million. We're now the second best total commitments of the last 10 years, and that's without any Chinese buying. We've been able to do it without Chinese buying. So I think a big part of the reason corn futures are trading, near their highs this morning is the trade's looking at exports, sales, shipments, and they're saying USDA is too low. They got to come up, and they didn't do it this past week, but maybe they're going to do it eventually.
Yeah, I think it was kind of touted that this report that we had was bearish, and I don't think it was by any means.
No.
I think it's just a timing aspect, right? When you look at the January report, the USDA lowered yield substantially. That lowers overall production. And just by the mechanics of how they operate, when they see that large of a production drop, they will offset partially by a reduction in demand. It's just how they operate. So then to expect them to come in the very next month and look at pace analysis and say, well, they're going to raise exports right back up again, it would look really sloppy for them to do that. I think you're going to see the increase in exports at some point, and maybe it's in the April WASDE report after we go through the quarterly stocks at the end of March. I think it's coming down the road. And until the USDA actually acknowledges that, I think you're going to keep a bid under the market looking for that bullish report in the future. But yeah, I mean, I really like when you look at the weekly exports. I love that Japan was the number one buyer because it used to be a huge customer, and Mexico has really taken the spotlight as far as our corn for export. So with Japan being the main buyer, I love that. I love that Mexico is the main buyer of wheat now. And I love that we are starting to see Mexico in some of these, was there a daily sale last week where Mexico bought corn, but new crop corn.
Yeah.
Right. So they're already in buying corn for next year. And I think we have to give Mexico a lot of credit. Everyone gets excited about, China coming in, but if Mexico finds value in corn at 465, 470 to come in and start purchasing that for their needs, I think that's a very positive sign.
I know that front loading argument has been around for a while. It's tough to stick with that narrative here in mid-February. Soybean sales are running average-ish relative to the last 10 years. We're not supposed to be doing a lot of bean business this time of year for current marketing year. This is Brazil's time to shine. Wheat sales also about average-ish.
So USDA released its weekly drought monitor data yesterday. Drought conditions across the Corn Belt were mostly unchanged last week, with the exception of abnormally dry conditions expanding from central Missouri over to west central Ohio. Currently, about 32% of the region is experiencing some level of drought, down substantially from 56% 3 months ago, but up from 23% a year ago. Drought conditions across the High Plains also remained mostly unchanged, except for worsening conditions in south central Nebraska and northwest Kansas. When we look at the percentage of U.S. areas experiencing drought, corn country 46%, soybeans 37%, winter wheat 23%, spring wheat 40%, and cattle country 38%.
Some of these numbers getting a little high. So almost half of U.S. corn country experiencing some sort of drought. Most of it's in the western corn belt, Iowa, and further west into the northern plains and even the central or southern plains. Brian, I think what I've been told is that the big corn acreage expansion in the spring is going to be a western corn belt thing, more so than an eastern corn belt thing. I know the market doesn't care about this yet. Do customers that you talk to care about this yet?
Yeah, guys out west are concerned.
Mhm.
They're worried about the possibility of drought. When we had our conference in Nashville, Eric Snodgrass, I think, did a really good job of presenting what he is watching as we progress over the next few months to get a sense of the likelihood of a drought. And it seems like kind of that number one thing is the water temperatures on the West Coast. And if they get cold, that is going to be a primary indicator of drought possibility in the Midwest. The other thing we absolutely have to watch is Texas, right? You look at that dark red there in Texas, and it's a small area right now, but if that really starts to expand as we go through the next couple of months, then that would be a major concern as well.
Yeah. Forecast is rain in my neighborhood in the southeast, but most of the central and western corn belt aren't going to see much over the next week or so. We had some inflation stuff yesterday.
We did. U.S. wholesale prices rose more than anticipated last month. According to the January PPI data released yesterday, wholesale prices increased 3.5% compared to the same month last year. Traders had expected a 3.2% annual gain. The increase in prices was largely fueled by higher food and energy costs. The combination of yesterday's PPI report and Wednesday's CPI report has greatly lowered the chances that the Fed will cut interest rates more than once this year. Some traders now anticipate that there will be no rate cuts this year due to the economic impact of Trump's proposed tariffs.
Brian, to go back to a question you asked me at the top of the show, what do you look like? You look like a fund manager. If you're a fund manager and you're seeing these hotter inflation prints, do you want to be short commodities?
Mm-mm. No.
You don't. I wouldn't. Three and a
No.
half percent at PPI is PPI is often a precursor to what you see at the consumer level. We're 3.5%. The Fed wants this thing at 2. It was down to almost 0, and now you're back to 3.5.
Yeah, and so and these inflation readings were hotter than expected by 0.2, 0.3, 0.4% on CPI, on PPI. If you kind of think back to 2022, like when we were in that inflation narrative, when you had a hot inflation print on a CPI or PPI, the funds would come in and buy,
Mm-hmm.
right? Because it's their hedge against inflation. Causing inflation is the hedge against inflation, right?
Yeah.
But that's just how it works. So I think there's I think there's a multitude of reasons why certain markets are going up. Obviously, you have corn, for example, has a good, solid fundamental story. We've talked
Mm-hmm.
about stocks domestically, globally, stocks to use, but then there's I think also an inflationary element to the buying as well. So I think about 2008 was an interesting year where commodities were treated almost as an asset class instead of just based on their own individual fundamentals. And there does seem to be kind of a sense of that again, where just commodity ownership looks attractive. You look at what gold is doing, it's absolutely nuts. And you think about like what we saw in cocoa last year, and now look at coffee. Coffee futures are moving parabolic, making new record highs. So there's definitely some things going on here globally that where certain markets are very strong. But I think as a whole, commodities are going to be looked at favorably with these type of inflationary prints.
Cattle market was mostly higher yesterday.
Yep, live cattle were 40 cents to $1.60 higher. Feeders saw gains ranging from 202 to $3 higher. Box beef was mixed. Choice was down 186 at 317.40, and select was up 70 cents at 309.84.
Hey guys, the markets are closed on Monday, right, Brian? We're closed Monday.
We're closed on Monday. We will open up the grain trade on Monday night for Tuesday's session, and then the livestock will open up at 8:30 on Tuesday morning.
Guys, have a nice long weekend. Happy Valentine's Day. Brian, thanks for joining us. See you next week.